Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, February the 14th. Happy Valentine's Day to all you guys out there. And my name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything we talk about in this market commentary is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, though, I am here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. Across the pond, we actually got quite a bit of data coming out today, so let's get on with it. Across the pond, German preliminary GDP came in at unchanged, expected to increase by 0.1%. Anything lower than expected is not necessarily considered to be good for the overall economy because, we would expect that if the economy is starting to kick up, we're going to see GDP, gross domestic product, start to increase. Not seeing that right now. And then we got German WPI coming in at a negative 0.7%, expected to be a positive 0.3%. So a big miss there. We got China PPI, China PPI month over month coming in at negative 0.7%, expected to be a negative 0.4%. European GDP came in at 0.2%, which was in line with expectations. Their flash employment change came in at 0.3%, slightly higher than the expected 0.2%. That is the only good one we've seen so far. And then we've got here back in the United States, core retail sales, a dismal negative 1.8%, expected to be unchanged. Revision to last month's number. They did revise that back down. They did no revisions to that number on the core retail sales from last month. Then we got retail sales, which basically includes autos and some of the more volatile aspects of that. That came in at a negative 1.2%, expected to be at a positive 0.1%. So a huge miss there as well. The revision from last month's number was supposed to be, or came out at 0.2%. It was revised down slightly to 0.1%. And then U.S. unemployment change came in at 239,000 claims, expected to be 225,000 claims. So when people are starting to claim unemployment, that's when we start to see these numbers get jacked, right? We've been seeing high employment, but a lot of people since 2009, and there's been people that have fallen off of the unemployment list and are now kind of re-entering the workforce, and that's where those claims start increasing. When they start feeling the economy is starting to move, they start looking for a job, and those claims can go up. One thing to note is they kind of missed the boat if they're starting now, because it looks like they're well behind the curve on this economy, like really firing on all cylinders. And then finally, we got business inventories. That was a drawdown of negative 0.1%, expected to be a positive 0.3%. So anytime they're moving inventories, that's a good thing for the businesses. It's a lot less cost going into their business. And then natural gas storages, drawdown of 78 billion cubic feet, in line with the drawdown of 79 billion cubic feet, which was expected. Talking about crude oil. Yesterday, we talked about the build. We keep seeing builds in crude oil. Not a whole lot of weakness seen yesterday. I would have expected it to roll over a little bit more. Goldman happened to come out with a report saying that crude oil should be trading about $64.50 by the year end. Now, if things are going the way we are looking right now, and that was a move up in their price target. That was before we got all these economic data. I've been showing you the economic data for a while now. It is not substantial enough to say that this crude oil has enough demand to drive it to $64 a barrel. I don't see it. So at least the way it's shaping up right now, I don't see the market really commanding that kind of pricing for crude oil, at least soon. I think that the economy is struggling to really fire on all cylinders right now, and oil is going to be one of those last things that really show demand, to be quite honest. Now we got Gold still up in the 13 handles. It did, or 13 handle. It did go down to test that area where the bulls defended that 13 handle. We've kind of pushed up and away. It's exacerbated by the fact that on this retail sales number, we got the equities falling out of bed. This was a flight to safety in that regard. So I think that gold is moving higher based on a little bit of fear going on in the equities based on the economic data we've been getting. Bonds reacting as well, almost up a point on the day. At one time today, they were up a point on the day, giving back a little bit at this point. They're stuck in a range, though. Remember, we're talking about Fed is not going to increase interest rates, which means the bonds can't go down. And I don't believe they are going to start lowering interest rates anytime soon. It might be the second half of the year at best. But I don't, and that would have to be a pretty bad economic outlook for that to happen. So bonds really kind of stuck here in this range as far as I can tell. Then we've got VIX moving higher today, was again much higher before the equities have started to try and take back some of those losses off the economic data points. But the VIX moving higher based on the equities being down on the day. Dow Jones Industrial average down 100 points on the day, but you can see the full range here came down, tested the 9-day moving average, and rallied back up to near the highs right now. Now, with these two charts, or the way the chart's setting up, if we were to finish today up in this area, that's a continuation pattern. It's going to look like we're going to start looking to peel through this 38 Fibonacci again, in the next few days. I'm expecting the equities to really show weakness, especially late into the day today, I'm thinking. NASDAQ unchanged right now. Again, they were down big on the day, up overnight and off the opening of the overnight session. Since then, it was mostly weakness after the economic data point. We'll see that show up in the E-mini S&Ps when we break it down on a 30-minute chart. Again, right here, very close to unchanged on E-mini S&Ps, down 5 points, but right there at that 38 Fibonacci extension there. This is what I'm talking about with the E-mini S&Ps. This is the economic data point coming out. You can see we were near the highs, not quite the highs. The highs were made overnight. But on that economic data point, just got slammed. As a matter of fact, the value area was almost above yesterday's value area before the market opened, and we got those data points. You can see it has extended it to the downside now at this point. Got a little bit of a bounce. I think that's mostly to shake out the weak hands. I think we're going to kind of resume to the downside. I don't see how you can get this dark cloud off of the markets today. That retail sales number, not good. A lot of it could be accounted for with the government shutdown, but I think that this is a huge miss. And we would have expected a little bit better, maybe a pullback after the Christmas holiday, but I'm telling you, this doesn't look good despite the fact that we had a government shutdown. All right, let's talk about the trades that I've done. YELP is a earnings trade that I did, obviously, right off the bat, completely directionally wrong. Even off the open, it wasn't looking too great, but I was able to get out of this for a nice profit with YELP. And in YELP, I went to the monthlies that expire tomorrow, which is the February. Sold the 44 calls in there for 61 cents. I was able to buy them back for 9 this morning. I was a little bit worried about it on the upside, but as you can tell, those 44 calls still, even if we had opened up at around 42, 43, I would have been able to get out for a profit. I put this order in a little bit earlier because before the open, thinking we may get a spike back up there and wanted to get out early. So I may have paid up a little bit by a couple of pennies, but I don't care. I'm out. I like to get out immediately on the open. You guys know that. I talk about that in the webinars. That is one of the main things because we don't know where it's going to go afterwards. It can continue to get worse. It could get better, but the snapshot I like is that early morning opening. With NTAP, which isn't one that I would normally suggest for everybody. The markets are a little bit wider in here. I played around with it, had some working orders in there to try and get my pricing for it, and was pretty happy with where I got out. And then I put this order in right off the open again before the open, knowing that this market was against me and not looking too good. I put in an order before the open to get out as fast as I could, as close to a scratch as I could. And with that being said, I went into the February as well, sold the 62 puts in there, originally for 64 cents, and then I got out of those for 60 cents. So, yeah, I put it in for, 58 cents. I was going to say I put it in for 60 cents, and then I think I lowered it right before the market opened. So about a 10-cent winner on that. Actually, not even 10 cents, about 5 cents winner. Maybe it covers the commissions on it. But the point is look how directionally wrong I was on this market. You can see it got slammed into my face, trading right in and around that $62 handle, which is where I'm short. But with that volatility crush coming out, directionally wrong didn't hurt me here because I played the probabilities. That's why I talk about this so much in my webinars, how to play the probabilities, let the probabilities play out, and when you're in an environment that is suitable for this type of situation, which is perfect for the earnings. Directionally wrong massively by several dollars and almost came down to my short puts. I got it on that pop. I put in a bid right before the open on that market rally. I got out. You can see that it probably wouldn't have been looking, it would probably be maybe right around where we are now with the decay and everything else happening. So all in all, out of those, the last one I need to talk about is GDX, which I got out of yesterday towards the end of the day. And with GDX, let me just look it up. Exactly what I had done, so I don't misstate what I had done. All right, so originally I went into the March and sold the 24 calls in there for 30 cents, and I was able to buy those back for 8 cents yesterday. Market moving down. I was working a nickel bid. It wasn't getting any better. It was basically 7 bid at 10 all day long. I had to pay up to 8. I'm good with that. That being said, all I really have is McDonald's, Johnson & Johnson. Those are my long premium strategies, long duration. I'm going to hold on to those. I would think with this market juking back and forth, we might get a little bit more movement out of both of those, but they seem to be content trading in and around where they are currently. So that being said, I'm just going to have to hold on to those and wait it out. Today's webinar is going to be on the call spread, but I'm doing it as a ratio call spread. It's great for a defined risk strategy, a bullish assumption, and we're going to add a little bit more risk for it to it so that we can implement it in and around a high implied volatility market. This is a high probability strategy, higher than just a long call spread. So I'll show you how to set that up today. That's what we love to do. Collect premium, high probability strategies. That's the way to win in this game, obviously, because you can be directionally wrong and still make money like I showed you today. All right, that's all I got for you. If you can't take that, take it easy.